I have seen brilliant people, doctors, lawyers, engineers, people with advanced degrees fall into this trap just as easily as anyone else. And here's the thing. This trap does not announce itself. It does not come with warning signs. It sneaks up on you. It comes dressed up in exciting stories and revolutionary technology and get-rich-quick promises. And before you know it, you are not investing anymore. You are speculating. You are gambling, and you do not even realize it. I want to tell you about the single biggest mistake that destroys investor wealth. I have been watching the markets for over 70 years, and I have seen this deadly trap wipe out fortunes over and over again. It is the confusion between price and value. Most investors think they are immune to it, but they are not. And today, I am going to show you exactly how this trap works, how to recognize it before it catches you, and how to protect yourself so you can build real, lasting wealth without losing sleep. So pull up a chair, because what I am about to share with you could save you from financial disaster. Well, hello there. Pull up a chair. I want to talk to you today about something that has been on my mind for quite some time now. You know, I have been watching the markets for over 70 years, and I have seen just about every kind of foolishness you can imagine. I have seen manias, panics, bubbles, and crashes. I have watched fortunes made and fortunes lost, and through it all, there is one mistake, one deadly trap that I see investors fall into over and over and over again. Now, this is not some complicated mathematical formula. It is not some exotic derivative or some newfangled financial instrument that nobody understands. No. This trap is far simpler than that. And that is what makes it so dangerous. Because it is so simple, people think they are immune to it. They think it cannot happen to them. But let me tell you, I have seen brilliant people, doctors, lawyers, engineers, people with advanced degrees fall into this trap just as easily as anyone else. So what is this trap? Well, it is the confusion between price and value. That is it. That is the whole ball game. People forget that price is what you pay and value is what you get. And when you confuse those two things, when you start thinking that just because something has a high price, it must have high value, or when you start believing that a rising price is the same thing as increasing value, well, that is when you are in real trouble. Now, I know what some of you are thinking. You are thinking, well, that sounds pretty basic. I would never make that mistake. But here is the thing. This trap does not announce itself. It does not come with warning signs. It sneaks up on you. It comes dressed up in exciting stories and revolutionary technology and get-rich-quick promises. It comes with charts that only go up and experts on television telling you that this time is different. And before you know it, you are not investing anymore. You are speculating. You are gambling. And you do not even realize it. I have to tell you, it breaks my heart when I see regular folks, people who work hard and save their money, throw it all away because they got caught up in the excitement of a bubble. They hear about their neighbor making a fortune in some hot stock, or they read about some new technology that is going to change the world, and they think to themselves, I need to get in on this. And so they do. They buy at high prices, convinced that the prices will go even higher. They abandon all the principles of sound investing. They stop asking basic questions like, what am I actually buying, or what is this business worth, or am I paying a fair price? Instead, they start thinking like gamblers. They start watching the ticker every 5 minutes. They start believing that the market is some kind of slot machine, and if they just pull the lever enough times, they are going to hit the jackpot. And you know what happens? What always happens? The music stops, the bubble bursts, the prices come crashing down, and all those paper profits disappear like smoke. Now, I want to be clear about something. I am not here to scold anyone. I am not here to say I told you so. I have made my own mistakes over the years, plenty of them. But what I have learned, what I want to share with you today, is how to recognize this trap before you fall into it. I want to give you the tools to protect yourself, because the thing is, this trap is going to come around again. It always does. Maybe it will be artificial intelligence stocks. Maybe it will be some new cryptocurrency. Maybe it will be something we have not even thought of yet. But it will come. And when it does, I want you to be ready. So that is what we are going to talk about today. We are going to talk about the difference between price and value. We are going to talk about speculation versus investment. We are going to look at history, because history rhymes, even if it does not repeat exactly. And we are going to discuss how you can build real, lasting wealth without falling into this deadly trap. Are you ready? Good. Let us get started. You know, when I was a young man, my mentor, Ben Graham, taught me something that changed my life. He said, Warren, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Now, what did he mean by that? Well, in the short run, stock prices are determined by popularity, by emotion, by fear and greed, by what everyone else is doing. If everyone wants to buy something, the price goes up. If everyone wants to sell, the price goes down. It does not matter what the business is actually worth. It only matters what people are willing to pay at that particular moment. That is the voting machine. But in the long run, and this is the important part, the market weighs, it measures, it figures out what things are actually worth. A business that generates real profits, that has real competitive advantages, that serves real customers, and solves real problems, that business will eventually be recognized for its true value. And a business that is all hype and no substance, that burns through cash and never makes a profit, well, eventually the market figures that out too. The problem is that most people cannot wait for the weighing to happen. They get caught up in the voting. They see prices rising and they think, I need to get in before it goes even higher. They see prices falling and they think, I need to get out before I lose everything. They are constantly reacting to what other people are doing instead of thinking independently about what things are actually worth. Let me give you an example. Imagine you own a small business. Maybe it is a furniture store. Every year, this store makes $100,000 in profit. Year after year, nice and steady. $100,000. Now, one day, somebody comes along and offers to buy your store for $500,000. That seems reasonable, right? You are getting 5 times the annual profit. That is a fair price. But then something strange happens. Somebody else comes along and offers you $1 million. Then another person offers you $2 million. Then $5 million. Then $10 million. And all of a sudden, people are standing in line to buy your furniture store for absolutely crazy prices. Now, I have to ask you, did your furniture store change? Is it making more profit? Does it have more customers? Is the furniture business suddenly more profitable than it was last week? No. Nothing changed about the actual business. But the price, the price is going through the roof. So what would you do? Well, I hope you would sell. I hope you would take that money and thank your lucky stars that somebody was willing to pay $10 million for a business that only makes $100,000 a year. Because eventually, the market is going to weigh that business. It is going to look at the actual profits, and whoever paid $10 million is going to realize they made a terrible, terrible mistake. But here is what actually happens in the stock market. When people see that furniture store stock going up and up and up, they do not think, this is crazy. This price makes no sense. No, they think, wow, I better buy some of that furniture store stock before it goes even higher. They see the rising price as evidence that it is a good investment. They forget to ask the most basic question, what is the actual business worth? And you know what they tell themselves? They tell themselves stories. They say, well, furniture is going to be huge in the future. Everyone needs furniture. This company is going to dominate the furniture industry. They have a revolutionary new way of selling chairs. They convince themselves that the price is justified. That somehow, some way, this furniture store is going to make enough profit to justify that $10 million price tag. But the math does not work. It never did. See, if you pay $10 million for a business that makes $100,000 a year, you are paying 100 times earnings. That means it would take 100 years of profit just to get your money back. Now, does that sound like a good investment to you? Of course not. But when everyone else is buying, when the price is going up every day, when there is excitement in the air, people forget to do the math. They stop thinking. They start believing in magic. And that, my friends, is the trap. The trap is believing that price tells you something about value. The trap is thinking that just because something is expensive, it must be good. The trap is confusing the voting machine with the weighing machine. The trap is forgetting that at the end of the day, a business is worth the cash it is going to generate for its owners over its lifetime. Nothing more, nothing less. Now, you might be wondering, well, how do I avoid this trap? How do I know when something is overpriced? And that is a great question. That is exactly what we need to talk about, because the answer is not always obvious. Sometimes things look expensive, but they are actually cheap. Sometimes things look cheap, but they are actually expensive. You need a framework. You need principles. You need a way of thinking about value that does not depend on what the market is doing on any given day. You know, they say those who do not learn from history are doomed to repeat it. And nowhere is that more true than in the stock market. Because this trap we are talking about, this confusion between price and value, it has happened over and over again throughout history. The details change, the technology changes, the names change, but the pattern is always the same. Let me take you back to the 1,920 seconds. Now, back then, radio was the hot new technology. It was revolutionary. It was going to change everything. And you know what? It did change everything. Radio really was an amazing invention. It transformed communication, entertainment, and news. But here is the thing. Just because radio was a great technology did not mean that radio stocks were a great investment at any price. People went absolutely crazy for radio stocks. They bid them up to astronomical levels. RCA, which was the big radio company at the time, went from a few dollars a share to over $500 a share in just a few years. Everyone wanted to own a piece of the radio revolution. And they told themselves, this time is different. This is not like the old boring railroad stocks or steel stocks. This is the future. But then 1,929 happened. The market crashed. And RCA, that wonderful company that was at the forefront of this amazing technology, it fell from over $500 a share down to about $3 a share. $3. Now, did radio stop being important? No. Did RCA stop being a real company? No. But the price that people were paying, it was not based on value. It was based on excitement and emotion and the fear of missing out. Now, fast forward to 1,999. I watched the same thing happen all over again with internet stocks. The internet was going to change the world. And guess what? It did change the world. The internet is one of the most important technological developments in human history. But that did not mean you should pay any price for internet stocks. I remember companies that had never made a penny of profit, that had no clear path to ever making a profit, trading for billions of dollars. I remember stocks that would double or triple in a single day for no reason other than they had .com in their name. I remember people quitting their jobs to day trade internet stocks. I remember being asked over and over again, Warren, why are you not buying technology stocks? Do you not understand the internet? Are you too old to see that this time is different? And I would tell people, I understand the internet just fine. What I do not understand is how some of these companies are worth billions of dollars when they are losing money hand over fist. But nobody wanted to hear that. They thought I was a dinosaur. They thought I was missing out on the future. The price kept going up, and that was all the proof they needed. Then March of 2000 came around, the bubble popped, and I watched trillions of dollars of wealth disappear. Not because the internet stopped being important, not because technology stopped advancing, but because people had paid prices that bore no relationship to value. They had forgotten to ask, what am I actually buying here? What is this business worth? I saw people lose their retirement savings. I saw people lose money they had borrowed to invest. I saw people who thought they were geniuses because they had made money in a rising market suddenly realize that they had just been lucky. And when the luck ran out, they had nothing left but losses. Now, here we are in 2025, and I see the same patterns starting to emerge again. Different technology, different names, but the same old story. People chasing prices instead of evaluating value. People convinced that this time is different. People forgetting that the laws of economics have not been repealed. And let me tell you something, this time is not different. It never is. Oh, sure, the details are different, the technology is different, but human nature never changes. Fear and greed, they're always with us. The desire to get rich quick, the fear of missing out, the tendency to follow the crowd, these things are hardwired into us. And as long as human nature stays the same, this trap will keep catching people. So what can we learn from history? Well, first, we can learn that great technology does not automatically mean great investments. Radio changed the world, but most radio stocks went to zero. The internet changed the world, but most .com stocks went to zero. The technology can be real and revolutionary, and you can still lose all your money if you pay too much. Second, we can learn that this time is different are the four most dangerous words in investing. Every bubble convinces people that the old rules do not apply anymore, that we have entered a new era where valuations do not matter, but they always matter. They always matter. Third, we can learn that the crowd is usually wrong at the extremes. When everyone is buying, when optimism is at its peak, when people cannot imagine prices going down, that is usually the time to be cautious. And when everyone is selling, when pessimism is overwhelming, when people cannot imagine prices going up, that is usually the time to be greedy. Now, I want to make an important distinction here. There is a big difference between investing and speculating. And I mean a really big difference. But most people use these words interchangeably, as if they mean the same thing. They do not. When you invest, you are buying a piece of a business. You are becoming a part owner. And as a part owner, you should care about the same things that any business owner cares about. How much profit does this business make? How much cash does it generate? Does it have competitive advantages that will allow it to keep making money in the future? Can it grow without requiring massive amounts of additional capital? These are the questions an investor asks. But when you speculate, you are not thinking about the business at all. You are thinking about the price. You are trying to guess whether someone else will pay more for this asset tomorrow than you are paying for it today. You are not buying because you believe in the business. You are buying because you believe the price will go up. And that is a very different game. Now let me be clear. There is nothing morally wrong with speculation. If you want to speculate, if you want to try to predict short-term price movements, that is your business. But you need to know that is what you are doing. You need to be honest with yourself, because speculation is risky. It is really, really risky. And most people who speculate end up losing money. Think about it this way. If I buy a farm, I am investing. I am looking at how much corn or soybeans that farm can produce. I am looking at the quality of the soil. I am thinking about what crops will sell for, what my costs will be, and how much profit I can make. I am not sitting there every day checking to see if someone will pay me more for the farm than I paid yesterday. I am focused on what the farm produces. But if I buy a bar of gold, I am speculating that gold does not produce anything. It just sits there. It does not create wealth. It does not generate cash flow. The only way I make money is if someone is willing to pay me more for that gold in the future than I paid for it today. And why would they pay more? Well, maybe because they think someone else will pay even more after that. It is a chain of speculation, and eventually that chain breaks. Now, here is where people get confused. They think that because they are buying stocks, they are investing. But that is not necessarily true. If you buy a stock just because you think the price will go up, if you have no idea what the underlying business does or whether it makes money or what it is actually worth, then you are not investing. You are speculating. You are playing a guessing game about what other people will do. And let me tell you, trying to guess what other people will do in the short term, that is a really hard game to win. Because other people are emotional, they are irrational, they panic when things go down, and they get euphoric when things go up. Mr. Market, as Ben Graham called him, is a manic depressive fellow. Some days he is wildly optimistic and will pay you absurd prices for your stocks. Other days he is deeply pessimistic and will only offer you pennies on the dollar. If you are trying to predict what Mr. Market is going to do next week or next month, well, good luck to you. Because I cannot do it, and I do not know anyone who can do it consistently. But here is the beautiful thing about investing. You do not need to predict what Mr. Market is going to do. You do not need to know whether stocks are going up or down next week or next month or even next year. All you need to know is what the business is worth. And if Mr. Market offers you a price that is significantly below what the business is worth, you buy. And if he offers you a price that is significantly above what the business is worth, you sell. And if the price is somewhere in between, you just wait. That is it. That is the whole secret. You do not need to be a genius. You do not need to predict the future. You just need to be able to evaluate businesses and wait for the right prices. It is simple, but it is not easy because it requires patience. It requires discipline. It requires you to ignore what everyone else is doing. And most people cannot do that. Most people cannot sit still. They feel like they need to be doing something all the time. They see prices moving and they think they need to react. They hear about hot stocks and they think they need to jump in. They get bored holding on to good businesses at reasonable prices because it is not exciting enough. They want action. They want to feel like they are doing something smart. But you know what? In investing, doing nothing is often the smartest thing you can do. If you own good businesses at good prices, the best strategy is usually just to hold on and let those businesses grow. Let time work for you. Let compound interest work its magic. Do not interrupt it by constantly buying and selling and trying to time the market. I have always said that the stock market is a device for transferring money from the impatient to the patient. And that is exactly what happens. The impatient people, the speculators, they are constantly churning their portfolios. They are paying fees and taxes. They are making decisions based on emotion. They are trying to catch the next big thing. And over time, they underperform. But the patient people, the real investors, they just sit tight. They own good businesses. They let those businesses compound. And over 20, 30, 40 years, they end up with substantial wealth. Not because they were smarter, not because they worked harder, but because they understood the difference between investing and speculating, because they understood that price and value are not the same thing, because they were willing to wait for value to be recognized. So how do you know when you are falling into this trap? How do you know when you have crossed the line from investing to speculating? Well, let me give you some warning signs. These are red flags that should make you stop and think very carefully about what you are doing. Warning sign number 1, you cannot explain what the business does. If someone asks you, what does this company do? How does it make money? And you cannot give a clear, simple answer, that is a problem. That is a big problem. Because if you do not understand the business, how can you possibly know what it is worth? I have always believed in staying within my circle of competence. That means I only invest in businesses I understand. Now, my circle of competence does not include everything. There are plenty of businesses I do not understand. And you know what I do with those businesses? I ignore them. I do not care how hot they are. I do not care how much money other people are making. If I do not understand it, I am not buying it. And let me tell you, my circle of competence has not grown much over the years. I still like simple businesses. I like businesses that sell products people need. I like businesses with competitive advantages that are easy to identify. I like businesses where I can reasonably estimate what they will be earning 10 years from now. If a business does not fit that description, I am not interested, and I sleep very well at night. But what do most people do? They see some complicated business and some complicated industry, and instead of saying, I do not understand this, they say, well, I better learn about it fast because everyone else is making money on it. And they do not really learn about it. They just learn enough buzzwords to convince themselves they understand. They learn the story. They learn the pitch, but they do not really understand how the business works or whether it can make money. Warning sign number 2, you are buying because the price is going up. This is a huge red flag. If the main reason you are buying something is because the price has been rising, you are not investing. You are speculating. You are momentum trading. And momentum can reverse very, very quickly. I have never bought a stock because it was going up. Never. I buy stocks because they are cheap relative to their value. Sometimes those stocks keep going down after I buy them. And you know what? That is fine with me. As long as the business is still sound and I bought at a good price, I am happy to wait. Eventually, the market will recognize the value. But if I was buying because the price was going up and then the price starts going down, well, now I have a problem. Because the whole reason I bought just disappeared. Warning sign number 3. You are thinking about what you will sell it for rather than what it will earn. This is subtle but important. When you invest in a business, you should be thinking about the cash that business will generate. How much profit will it make? How much will it grow? What will those earnings be worth? But when you speculate, you are thinking about the exit. You are thinking, I will buy this at $10 and sell it at $20. You are thinking about price targets. You are thinking about technical charts. You are not thinking about the business at all. You are thinking about the next person who will buy it from you. I call this the greater fool theory. You are buying something not because you think it has value, but because you think there is a greater fool out there who will pay you even more. And sometimes that works. Sometimes there is a greater fool. But eventually, you run out of fools. And when that happens, you are left holding the bag. Warning sign number 4. You are borrowing money to invest. Oh boy, this is a really dangerous one. If you are borrowing money to buy stocks, you are asking for trouble. You are amplifying your risk tremendously because now you can lose more than you invested. Now you have to pay interest. Now you have pressure to sell at the worst possible time. I have never borrowed money to invest in stocks. Never. And I never will. Even when I was young and did not have much money, I only invested what I actually had. Because borrowing money to invest assumes that you know what is going to happen in the short term. And you do not. Nobody does. The market can stay irrational longer than you can stay solvent. And if you are leveraged, if you are borrowing money, you might be forced to sell at exactly the wrong time. Warning sign number 5, you are checking the price constantly. If you find yourself looking at stock prices multiple times a day, that is a bad sign. It means you are focused on price fluctuations instead of business value. It means you are thinking short-term instead of long-term. It means you are probably going to make emotional decisions. I do not check stock prices very often. In fact, I would be perfectly happy if the stock market closed for a couple of years because I own businesses, not pieces of paper. I care about what those businesses are doing, not what the market thinks about them on any given day. If you are obsessively checking prices, you need to ask yourself why. What are you looking for? What are you worried about? And chances are the answer will reveal that you are speculating rather than investing. Warning sign number 6. You are invested in something because everyone else is. The fear of missing out is a powerful emotion. You see your friends making money. You see people on the internet talking about their gains. You feel like you are being left behind. And so you jump in, not because you have evaluated the investment and decided it makes sense, but because you do not want to be the only one not making money. But let me tell you, following the crowd is a great way to lose money. Because by the time everyone is buying something, by the time it is the topic of conversation at cocktail parties, it is usually too late. The easy money has already been made, the price has already been bid up, and you are buying at or near the top. The best investments I have ever made were not popular at the time. They were often things that other people were selling or ignoring. They were out of favor, they were boring, they were not exciting. But they were cheap, and that is what mattered. Now, let us talk about how you actually determine what something is worth, because that is the real skill in investing. Anyone can look up a stock price, but figuring out what a business is actually worth, that takes some thought, that takes some work. The first thing you need to understand is that a business is worth the sum of all the cash it will generate for its owners over its lifetime, discounted back to today. Now, I know that sounds complicated, but it is really not. Let me break it down. Imagine you own a little business that makes $10,000 a year in profit. Every year, like clockwork, $10,000. Now, how much is that business worth? Well, it depends on how long it will keep making that $10,000 and what else you could do with your money. If you could put your money in a safe government bond and earn 5%, that means every dollar you invest should generate 5 cents a year. So to earn $10,000 a year, you would need to invest $200,000 in bonds. That means our little business that earns $10,000 a year is worth about $200,000. Maybe a bit more if you think the profits will grow, maybe a bit less if you think there is risk. But that is the basic idea. Now, the tricky part is figuring out how much that business will earn in the future. And this is where you need to be honest with yourself. You need to be conservative. You need to think about what could go wrong, not just what could go right. Ben Graham taught me about something called margin of safety. This is one of the most important concepts in investing. The idea is simple. Do not pay full price. Do not even pay 90% of what you think something is worth. Build in a cushion. Build in room for error. Why? Because your estimates are going to be wrong sometimes. Maybe you are too optimistic about the growth. Maybe you miss some risk. Maybe the economy turns bad. Maybe a competitor comes along. There are 1,000 things that can happen that you did not anticipate. And if you paid full price, if you paid exactly what you calculated the business was worth, you do not have any protection. You do not have any margin for error. But if you only buy when you can get something for 50 cents or 60 cents on the dollar, now you have protection. Now, even if your estimates are a bit off, you can still do okay. You have given yourself room to be wrong. Let me give you a concrete example. Say I think a business is worth $100 a share based on my analysis. I have looked at the earnings, the growth prospects, the competitive position, everything, and I am pretty confident it is worth $100. Should I buy it at $100? No. Should I buy it at $90? Still no. I would wait until I could buy it at $60 or $70. That way, I have a 30 to 40% margin of safety. Now, some people say, but Warren, if you wait for that big of a discount, you are going to miss a lot of opportunities. Most stocks do not get that cheap, and that is true. I miss a lot of opportunities. I miss most opportunities, actually. But that is okay, because the opportunities I do take, the ones where I really do have a margin of safety, those work out pretty well. And I do not lose money on the ones I pass on, because I did not buy them. You see, in investing, you do not have to swing at every pitch. This is not baseball where you will strike out if you do not swing. You can just stand there and wait for the perfect pitch. You can wait for something in your sweet spot at a price you like, and you can let all the other pitches go by. There is no penalty for being patient, but most people cannot do this. They feel like they need to be invested all the time. They feel like they need to have an opinion on every stock. They feel like if they are not doing something, they are missing out. And that is where they get into trouble. I would rather hold cash and do nothing than buy something at a price that does not make sense. Cash is not exciting. It does not go up, but it does not go down either. And it gives you the ability to act when real opportunities come along. When everyone else is panicking and selling, when prices are truly cheap, that is when you want to have cash. That is when you want to be able to buy. Now, how do you evaluate what a business will earn in the future? Well, you look at the track record. Has this business been consistently profitable, or does it have wild swings in earnings? You look at the competitive position. Does this business have something special that allows it to keep competitors at bay? Is it the low-cost producer? Does it have a powerful brand? Does it have a network effect where it gets stronger as more people use it? You look at the management. Are these people honest? Are they smart? Do they care about shareholders? Or are they paying themselves enormous salaries and making foolish acquisitions? You look at the financials. Is this business generating real cash? Or are the earnings just accounting magic? Does it require constant investment just to stay in place? Or does it generate more cash than it needs? These are the questions that matter. These are the things that determine value. Not the stock price, not what analysts are saying, not what the chart looks like. The fundamentals, the actual business reality. People often ask me, Warren, what is the secret to successful investing? And they expect some complicated formula or some insider knowledge. But the truth is much simpler than that. The secret is patience and discipline. That is it. Those two things will take you further than any fancy analysis or complex strategy. Patience means waiting for the right opportunity. It means not forcing things. It means being comfortable doing nothing when there is nothing good to do. And let me tell you, that is harder than it sounds, because our brains are wired for action. We want to feel productive. We want to feel like we are making progress. And just sitting there with cash, waiting for the right pitch, that does not feel productive. It feels like you are missing out. But here's what I have learned over 7 decades. The money is made in the waiting. The really big returns come from buying something truly wonderful at a truly cheap price and then holding on while the value gets recognized. That can take years. It can take a decade. But if you have the patience to wait, if you have the discipline to hold on through the ups and downs, you will be rewarded. I bought Coca-Cola stock in 1988. Now, Coca-Cola was not some unknown company. It was not some hot new thing. It had been around for over a century. Everyone knew what Coca-Cola was. But the stock had gotten cheap relative to the value of the business. The market was worried about some things that I thought were temporary. And so I bought a lot of stock. I mean a lot. It became one of our largest holdings. Now, did that stock go straight up after I bought it? No. There were times it went down. There were times people questioned whether I had made a mistake. But I did not care about any of that. And I was not buying Coca-Cola to sell it next year or even in 5 years. I was buying a wonderful business at a good price. And I was willing to be patient. And you know what? That investment has worked out pretty well. Not because I was smart enough to predict what the stock would do in the short term, but because I understood the value of the business. I paid a reasonable price, and I had the patience to let that value compound over time. Discipline means sticking to your principles even when it is hard, even when everyone else is doing something different, even when you feel stupid for not following the crowd. Discipline means saying no to things that do not meet your standards, even if they are going up and even if you are going to look foolish in the short term. The hardest time to be disciplined is during a bubble. Because during a bubble, it seems like everyone is making money except you. Your neighbor is making money. Your brother-in-law is making money. People who do not know anything about investing are making money. And you are sitting there with your boring old stocks or your cash, and you feel like an idiot. I know this feeling. I have lived through it multiple times. During the late 1990 seconds, when internet stocks were going crazy, people thought I had lost my mind. They thought I was too old to understand the new economy. They thought I was missing out on the opportunity of a lifetime. Our stock, Berkshire Hathaway, it actually went down during that period. While the NASDAQ was doubling and tripling, we were going backwards. And I had people, smart people I respected, telling me I needed to change. I needed to buy technology stocks. I needed to get with the times. But I did not change because I knew that what I was doing made sense. I knew that paying 100 times earnings for companies with no profits, that did not make sense. I knew that my principles were sound, even if they were not working in the short term. And then the bubble burst, and suddenly, all those geniuses who were making so much money, they lost it all. And our approach, that boring old value investing approach, it started working again. Because it always works in the long run. Not every quarter, not every year, but over time, over a full market cycle, discipline pays off. Now, discipline also means being willing to admit when you are wrong. I am not always right. Nobody is. And when I make a mistake, when I misjudge a business or pay too much, I need to recognize that and deal with it. Maybe that means selling. Maybe that means just accepting a lower return than I hoped for. But I cannot let ego or stubbornness keep me in a bad investment just because I do not want to admit I was wrong. The key is to make sure your mistakes are small. If you buy with a margin of safety, if you diversify reasonably, if you do not bet the farm on any single idea, then even when you are wrong, it is not going to kill you. You can absorb the loss and move on. But if you are taking big concentrated bets on things you do not really understand, if you are leveraged, if you are hoping for the best instead of preparing for the worst, well, one big mistake can wipe you out. I think about risk very differently than most people. Most people think risk is volatility. They think a stock that bounces around a lot is risky. But that is not how I think about it. To me, risk is the permanent loss of capital. Risk is buying something at such a high price that you cannot possibly get your money back. Risk is not understanding what you own. Risk is being forced to sell at the wrong time. And here is the thing. If you buy wonderful businesses at reasonable prices, The volatility does not matter. The stock might go down. It probably will go down at some point. But if the business is sound, if it keeps generating cash, if you did not overpay, then you are not really at risk. You can just hold on. Eventually, the price will reflect the value. But if you buy a mediocre business at a high price, you are at risk even if the stock is not volatile, because you paid too much, because the business might not generate the returns you hope for, because you do not have a margin of safety. And that is true risk. Now, let us talk about what you should be looking for, because not all businesses are created equal. Some businesses are wonderful, some are good, some are mediocre, and some are just terrible. And the price you should pay depends entirely on what kind of business you are buying. A wonderful business is one that has what I call a moat. A moat is a competitive advantage that protects the business from competition. Just like a moat around a castle keeps enemies out, a business moat keeps competitors from stealing your customers and your profits. There are different kinds of moats. Some businesses have a moat because they are the low-cost producer. Think about a company like Costco. They can sell things cheaper than almost anyone else because of their scale and their efficiency. If you try to compete with them on price, you are going to lose. That is a moat. Some businesses have a moat because of their brand. Think about Coca-Cola again. People do not just want a cola, they want a Coke. They have an emotional connection to that brand. They trust it. They have memories associated with it. You could make a cola that tastes exactly the same, maybe even better, and sell it for less money. But most people would still buy Coke. That is the power of a brand moat. Some businesses have a moat because of network effects. Think about a credit card company. The more merchants that accept the card, the more valuable it is to consumers. And the more consumers that have the card, the more merchants want to accept it. It is a virtuous cycle. And once you have established that network, it is really hard for a competitor to break in. That is a network effect moat. Some businesses have a moat because of regulation or licenses or patents. These are less durable because regulations can change and patents expire. But while they last, they can provide real protection. The key question you need to ask is, 10 years from now, will this business still have its competitive advantage? Will the moat still be there? Because if the moat is weak or temporary, then the business might make good money today, but it will not last. Competition will come in, profit margins will get squeezed, and you will not get the returns you hope for. I like businesses where I can look out 10 or 20 years and feel confident that the moat will still be intact. I like businesses where the competitive advantage is getting stronger over time, not weaker. Those are the businesses that can compound at good rates for long periods, and that is where real wealth is built. But here is the thing. Even a wonderful business is not a good investment at the wrong price. If you overpay, even for a great business, your returns will be poor. That is just math. If you pay too much going in, it does not matter how good the business is. You are starting from a hole. That is why you need both things. You need a wonderful business and a reasonable price. One without the other does not work. A wonderful business at a crazy price is a bad investment. And a terrible business at a cheap price is usually still a bad investment, because the business might just keep getting worse. When I was young, I used to buy cigar butt businesses. These were terrible businesses that were selling for less than the value of their assets. I could buy them cheap, liquidate them, or squeeze out one last puff of profit and make a small return. But it was hard work, and it was not very satisfying, and most importantly, it did not scale. I could not build long-term wealth that way. Then I met Charlie Munger, and he taught me something really important. He said it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price, and he was absolutely right. Because a wonderful company will keep creating value. It will grow. it will compound, and over time, even if you paid a fair price instead of a bargain price, you will do very well. But a mediocre company, even if you buy it cheap, it is not going anywhere. It might even be going backwards. So what other characteristics should you look for in a business? Well, I like businesses that do not require a lot of capital to grow. Some businesses, they have to keep investing just to stay in place. They need new equipment, new factories, new technology just to maintain their current level of profits. That is not ideal, because all that cash they generate, they have to plow it right back into the business. There is nothing left over for shareholders. But other businesses, they can grow without requiring much capital. A software business, for example, once you have developed the software, you can sell it to more and more customers without much additional investment. The incremental margins are very high. Same thing with certain service businesses or businesses with strong brands. They can grow their profits without having to invest proportionally more capital. And that means more cash for the owners. That is what you want. I also like businesses that are easy to understand. If I cannot figure out what the business does and how it makes money in a few minutes, I am probably not going to invest in it. Not because I am not smart enough to understand it, but because I do not want to spend my time trying to figure out complicated businesses when there are simple businesses available. And finally, I like businesses with honest, capable management. This is really important. You are trusting these people with your money. You need to believe that they will do the right thing, that they will allocate capital wisely, that they will not waste money on foolish acquisitions or pay themselves ridiculous compensation packages, that they will think about shareholders as partners, not as a source of funds to be exploited. How do you evaluate management? Well, you look at their track record. You look at what they have done in the past. Have they been good stewards of capital? Have they been honest in their communications? Have they delivered on their promises? You also look at how they compensate themselves. Are they getting rich regardless of how shareholders do? Or is their compensation tied to actual performance? So we have talked about what the trap looks like. We've talked about how to identify good businesses and reasonable prices. But there is still a big challenge. How do you actually stay rational when everyone around you is losing their minds? How do you stick to your principles when the market is doing something completely crazy? This is where most people fail. Not because they do not know the principles, but because they cannot follow them when it matters. It is easy to say you will be greedy when others are fearful and fearful when others are greedy. But actually doing it when real money's on the line, when social pressure is intense, when your emotions are running high, that is a different story. Let me tell you what I do. First, I ignore the noise. And there is a lot of noise out there. There are financial news channels running 24 hours a day, talking about every tick up and down in the market. There are experts making predictions. There are headlines designed to scare you or excite you. And none of it matters. None of it helps you make better investment decisions. I do not watch financial television. I do not check stock prices throughout the day. I do not read market commentary. Why? Because it is all short-term noise. It is all about what is happening right now, today, this minute. But I am investing for the long term. What happens today or this week or even this year, it just does not matter that much in the grand scheme of things. Now, I do read. I read a lot, but I read annual reports. I read about businesses and industries. I read history. I read things that help me understand value, not things that tell me where prices are going tomorrow. Second, I think independently. This is crucial. You cannot be a successful investor if you are just following what everyone else is doing. You need to form your own opinions based on your own analysis. You need to be willing to stand alone. Ben Graham used to say that you are neither right nor wrong because the crowd disagrees with you. You are right because your facts and your reasoning are right. That is what matters, not consensus, not popularity. Facts and reasoning, and this means you have to be comfortable being different. You have to be comfortable owning things that other people do not like. You have to be comfortable missing out on things that everyone else is excited about. You have to be okay with people thinking you are foolish or old-fashioned or out of touch. During my career, there have been many times when people thought I was making mistakes, many times when our approach was out of favor, many times when we looked stupid. But I did not change what I was doing because I knew my reasoning was sound, and eventually things worked out. Third, I have a process. I do not make investment decisions based on emotion or instinct or gut feeling. I have a systematic way of evaluating businesses. I look at certain metrics. I ask certain questions. I go through certain steps. And I only buy when all the criteria are met. This process protects me from myself. It protects me from getting caught up in the excitement, because even though I have been doing this for 70 years, I am still human. I still feel the pull of a good story. I still feel the fear of missing out, but my process keeps me grounded. It reminds me of what actually matters. Fourth, I maintain a long-term perspective. I am not trying to make money next quarter or next year. I am trying to compound wealth over decades. And that long-term perspective changes everything. It means I do not panic when things go down. It means I do not get euphoric when things go up. It means I can ignore all the short-term noise and focus on what really matters, the long-term value of the businesses I own. You know, if you told me that the stock market was going to be closed for the next 5 years, I would not care. I would not change anything I am doing, because I am not relying on the market to tell me what my investments are worth. I know what they are worth based on my analysis of the underlying businesses. The market can think whatever it wants. Eventually, it will come around to the right answer. Fifth, I stay within my circle of competence. I mentioned this earlier, but it is worth repeating. I only invest in things I understand, and that eliminates a lot of temptation. When some hot new technology comes along that I do not understand, I do not feel bad about missing it. It is outside my circle. That is okay. There are plenty of opportunities within my circle. And here is the beautiful thing. My circle does not need to be huge. I do not need to understand every industry or every type of business. I just need to understand a few things really, really well. And if I can find enough good opportunities within my circle of competence, that is all I need. Sixth, I remember my history. I have lived through a lot of market cycles. I have seen bubbles inflate and pop. I have seen panics and crashes. I have seen incredible pessimism and incredible optimism. And I have learned that these extremes never last. The pendulum always swings back. So when I see everyone getting excited about something, when prices are rising rapidly, when people are convinced that this time is different, I remember 1,929. I remember 1,999. I remember all the other times people thought the rules had changed. And I remember what happened next. That history gives me perspective. It helps me stay grounded when everyone else is losing their minds. And finally, I stay humble. I know I am going to make mistakes. I know there are things I do not know. I know the future is uncertain, so I do not make big concentrated bets on uncertain outcomes. I do not use leverage. I do not take unnecessary risks. I build in that margin of safety we talked about earlier. I give myself room to be wrong. So here we are. We have covered a lot of ground today. We have talked about the deadly trap of confusing price with value. We have talked about speculation versus investment. We have talked about patience and discipline. We have talked about what makes a good business and how to stay rational in an irrational world. Now I want to leave you with some practical advice. Some things you can actually do to protect yourself from this trap and build real wealth over time. First, educate yourself. Read, learn, but read the right things. Read Ben Graham's The Intelligent Investor. Read annual reports of businesses you are interested in. Read about business history. Read biographies of successful business people. Do not waste your time reading market predictions or hot stock tips or get-rich-quick schemes. Those things are worse than useless. They are actively harmful because they fill your head with nonsense. Real investment knowledge is not about predicting the future. It is about understanding businesses and understanding value. And that kind of knowledge you can acquire. It takes time. It takes effort. But anyone with reasonable intelligence and a willingness to learn can do it. Second, start small and learn as you go. Do not take your entire life savings and put it into the stock market all at once, especially if you are just starting out. Start with an amount you can afford to lose. Make some investments. Watch how they perform. Learn from your mistakes. Build your confidence and your competence gradually. I started with very little money, but I learned with every investment I made. Some of those early investments worked out, some did not, but each one taught me something. And over time I got better at it. You can do the same thing. Third, be patient. This is so important, I am going to say it again. Be patient. Wealth is not built overnight. It is built slowly, steadily, over decades. It is built by making sound decisions, avoiding big mistakes, and letting compound interest do its work. You know, compound interest is the most powerful force in investing. Einstein supposedly called it the eighth wonder of the world, and he was right. If you can earn decent returns and reinvest those returns and let the whole thing compound over decades, the results are extraordinary. But it requires time. It requires patience. It requires you to not interrupt the process. If you invest $10,000 and earn 10% a year, in 10 years you will have about $26,000. Not bad. But in 30 years, you will have over $170,000. And in 50 years, you will have over $1 million. Same investment, same return, just more time. That is the power of compounding. But here is the problem. Most people cannot wait. They want the $1 million now. They want to get rich quick. And so they take risks they should not take. They chase hot stocks. They speculate. And they interrupt the compounding process. And that is why most people never build real wealth. Fourth, live below your means and save. This seems obvious, but it is critical. You cannot invest if you do not have money to invest. And you cannot have money to invest if you spend everything you earn. So spend less than you make. Save the difference. Invest those savings wisely and let them compound. I have always lived relatively modestly. I still live in the house I bought in 1958. I do not own a yacht or a private jet. I do not buy expensive cars or fancy watches. Not because I cannot afford those things, but because I do not need them. They do not make me happy. And the money I did not spend on those things, I invested. And those investments compounded into real wealth. You do not need to be as extreme as me, but the principle is sound. If you can save and invest a meaningful portion of your income, and if you can do that consistently over many years, you will build wealth. It is that simple. Fifth, avoid debt. I mentioned this earlier, but it bears repeating. Debt is dangerous, especially debt used to invest. Do not borrow money to buy stocks. Do not buy things on credit that you cannot afford. Debt creates pressure. It creates risk. It forces you to make decisions at the worst possible times. Now, there are some kinds of debt that can make sense. A mortgage on a house, if the payment is reasonable, that can be okay. Student loans for a valuable education, that can be okay. But consumer debt, credit card debt, borrowing to invest, those are almost always bad ideas. Sixth, think for yourself. Do not blindly follow advice, even from me. Evaluate everything, ask questions, make sure you understand, make sure it makes sense to you, because at the end of the day, it is your money. You are the one who will live with the consequences of your decisions. There are a lot of people out there who want to tell you what to do with your money. Some of them mean well, some of them do not. Some of them know what they are talking about, most of them do not. You need to be able to separate the wheat from the chaff. And the only way to do that is to educate yourself and think independently. Seventh, do not try to time the market. You will hear people say, sell before the crash or wait for the bottom to buy. And it sounds sensible, but it does not work. Nobody can consistently predict when markets are going to go up or down in the short term. Nobody. I have never made a penny trying to time the market. Never. And I do not know anyone who has done it successfully over long periods. What I have done is bought good businesses at good prices whenever I found them. Sometimes the market went up after I bought. Sometimes it went down. But over the long term, if I bought well, things worked out. Eighth, focus on avoiding big mistakes, not on hitting home runs. In investing, it is more important to avoid losses than to chase huge gains. If you lose 50% of your money, you need to make 100% just to get back to even. And that is a hole that is very hard to climb out of. So do not take big risks hoping for big rewards. Take small risks with asymmetric upside. Buy things with a margin of safety. Diversify reasonably. Do not use leverage. Protect your downside. If you can avoid big losses, the compound returns will take care of themselves over time. And finally, remember why you are doing this. You are not investing to get rich quick. You are not investing to impress people. You are not investing because it is exciting or fun. You are investing to build financial security for yourself and your family. You are investing to have options in life. You are investing to be able to do the things you want to do without worrying about money. Keep that goal in mind. It will help you stay disciplined. It will help you avoid temptation. It will help you make sound decisions instead of emotional ones. You know, at the end of the day, investing is not really about money. Money is just a tool. It is a means to an end. What really matters is having a good life, having relationships you care about, doing work that is meaningful, having the freedom to pursue your interests, making a positive difference in the world. If you can invest wisely, if you can build financial security, those things become easier. You have more choices. You have more freedom. You have less stress. But the investing is not the end goal. It is just the vehicle that gets you there. So do not let the pursuit of money consume you. Do not let the stock market dictate your mood or your self-worth. Do not confuse a rising stock price with success or a falling stock price with failure. Focus on making sound decisions based on sound principles. Focus on the long term. Focus on avoiding the trap of confusing price with value. If you can do that, if you can be patient and disciplined and rational, you will do just fine. You may not get rich overnight. You may not have exciting stories to tell at cocktail parties. But over time, over decades, you will build real wealth. And you will do it without losing sleep, without taking foolish risks, without falling into the deadly trap that catches so many investors. That is my message to you today. That is what I have learned over more than 70 years of investing, and I hope it helps you on your journey. Now, I am going to leave you with one final thought. The stock market is going to do what it is going to do. There will be ups and downs. There will be bubbles and crashes. There will be periods of euphoria and periods of despair. And through it all, remember this: you do not need to participate in every movement. You do not need to catch every trend. You do not need to have an opinion on every stock. What you need to do is wait for the opportunities that make sense. The opportunities where you understand the business, where the price is right, where you have a margin of safety. And when those opportunities come along, and they will come along, you act, and then you wait some more. It is simple, but simple is not the same as easy. It takes discipline, it takes patience, it takes the courage to stand apart from the crowd. But if you can do it, the rewards are substantial. Not just financial rewards, but the satisfaction of knowing you did it the right way, that you did not gamble, that you did not speculate, that you invested. So good luck to you. Be patient, be disciplined, think for yourself, and whatever you do, do not fall for the deadly trap of confusing price with value. If you can remember that one lesson, you will be ahead of most investors out there. Thank you for your time today. I hope this has been helpful, and I wish you all the best in your investing journey. Take care now.